Hi, I'm Zarifa Boram, and this is my channel. This channel has been specially designed in order to contribute videos with regard to the subject of commerce, scaling from the subjects of accounting, economics, business studies, to even more broader subjects like studying about TNCs, about management accounting, etc. Thereby, this channel caters the needs of students attending school up to the postgraduate level. Hope that you will enjoy my videos and hope my knowledge will be shared across the world, making the maximum use of it. So just for you to get some kind of an idea about the videos that I have uploaded thus far, considering my video list, these are some of my videos which I have uploaded over the past few years, and today actually I'm bringing forward much more requested video regarding the IGCSE O-level accounting past paper discussion, since we have just a couple of months heading with the June examinations of 2019. Hope you enjoy my videos, and do not forget to subscribe to the channel and post your comments if any. Getting back into accounting IGCSE Edexcel 2018 June paper, considering the MCQs, the first MCQ says, Wong sells goods on credit to Chang. How would Chang record this transaction in his books? In this case, Wong sells goods on credit to Chang, which means that Wong is the seller, Chang is the buyer, and the transaction happens on credit basis. The question asks us, how would Chang record this transaction in his books? Simply considering, when the purchaser or when Chang records this transaction in his books, he has to consider it in terms of the purchaser's point of view. So when he purchases more and more goods from Wong, he has to pay more and more to Wong, which means his expenses increase. Based on the rule of double entry, when expenses increase, it should be debited. Therefore, the purchaser's account is supposed to be debited. Since Chang owes Wong, because this transaction took place on credit basis, Wong becomes a liability to Chang. Therefore, when liabilities increase, it should be credited. This is why the answer is option C. So, the gist of this question is that whenever there is a credit purchase, the basic double entry is that the purchaser's account is debited and the relevant trade payable or the creditor or to whom we have to pay is credited. Therefore, the answer is option C. Considering question 2 of the same paper, which of the following is a primary accounting record? When it comes to accounting, the accounting process starts with the occurrence of transactions. For example, let's think we purchase an item from KFC. When we pay on cash at that moment, we receive something called a receipt, and that is a source document for us. In other words, it's a document of proof. So what actually happens is, using the information of these source documents, KFC will generate something called books of accounts, in which we have the prime entry books at first. So prime entry books are the books of accounts where the transactions are recorded initially, first of all, using the documents of proof. So this question asks, which of the following is a primary accounting record? That means this question asks us, out of these given options, what is the book of primary entry, or the book of prime entry where we record the transactions at first? So the general ledger is totally out, because the general ledger is prepared after preparing the books of prime entry, in simple terms, general ledger is used to record all the T accounts except for cash, bank, trade receivables and trade payables. So it cannot be the answer, it's obvious. Considering petty cash book, yes, it is a book of prime entry. Indeed, it is a book of prime entry as well as a ledger, because it acts as a T account since it has a debit and credit side, as well as it enters the details of minor cash transactions. Considering the third option, sales ledger, obvious, it's not again a possible option because it's another ledger. And to be in depth, sales ledger actually records trade receivables T accounts, so it's out of the options. And considering trial balance, it's totally out because it is prepared even after preparing the ledger. In other words, the trial balance is basically the summary of all the ledger accounts. So it indicates the closing balances of the ledger accounts at a certain date, normally which is the end of a month. So therefore the answer is option B, which is petty cash book. Concluding question number 2, let's move on to question 3. So, which of the following pairs of accounts always have credit balances? This question is from the basic accounting theory. Normally in accounting, we have a simple theory to remember. That's all assets and expenses have debit balances usually, whereas all liabilities, capital and income have credit balances. So the answer is direct. It asks what is the pair that has credit balances. So it's obvious, it's capital and income. So recapping the theory for you, all assets and expenses normally have a debit balance. All liabilities, capital and income have a credit balance. Considering question number 4, it says, which of the following is an intangible fixed asset? So, intangible means we cannot see or touch, whereas fixed asset means an asset that gives a long-term benefit to the business. So, in other words, an asset is basically a resource of the business. So, we have to identify the option which gives us a resource that gives the business a benefit in the long run, which is not visible, as well as which we cannot touch. Considering option A, bank loan, it's not an asset to us because we got to pay it back someday, so it's a liability, so it's out of the options. Option B, debtors. Debtors mean people who have bought products from us and they owe us. So normally they have to settle within a year's time. Therefore, they are not going to provide us long-term benefits. Considering part C, that's goodwill. Yes, goodwill is an intangible fixed asset because it provides a long-term benefit. If you have a goodwill, it's easy for you to gather investors. It's going to be easy for you to gather a lot of good customers. So it's providing you long-term benefit and we cannot see or touch it. And option D, yes, it's a fixed asset, but it's not intangible because we can see and touch premises. Therefore, the answer is option C, goodwill. Considering the 5th question, it says, in which section of a balance sheet will a credit balance on a business bank account be shown? So, a credit balance on a business bank account. Normally, business bank account has a debit balance because bank account is supposed to be an asset of the business because it indicates the amount of money which the business has saved in a particular bank account or has maintained in a particular bank account. But if it does have a credit balance, that definitely indicates there is a negative bank balance, which means it's a bank overdraft. That means the business has to settle that amount of funds to the bank as soon as possible or within a given time period. Therefore, it is definitely a liability for sure. And normally banks do not allow the business to have this negative bank balance for more than a year, which means obvious it is a current liability. So the answer is option B. Considering question number 6, Which of the following would be regarded as an item of capital expenditure for a motor vehicle business? So here we have to be very careful because we're dealing with a motor vehicle business. So motor vehicle business will be buying and selling motor vehicles. So we need to think of the expenditure that gives us a long-term benefit, because that's what capital expenditure means. If you take the purchase of a car for resale, if you purchase a car for resale, you're gonna get the benefit out of it in the short run. So obviously it's not a capital expenditure. But purchase of equipment for business use, yes, it is a capital expenditure because we're gonna use this equipment for more than a year. Concerning repair and redecoration of business premises, no, it's not gonna be a capital expenditure because we might have to repair the business premises more than once in a year, and we might have to redecorate it based on the different seasonal changes or during promotions. So it's not a capital expenditure. And road tax and insurance payments for a delivery van, yes, it is not a capital expenditure because we need to make it through, and we need to make it through quite often. So the answer is option B, which is purchase of equipment for business use. Considering question number 7, it asks us, if capital expenditure is treated as a revenue expenditure, which of the following will be incorrect? Well, again, this is a question with regard to capital and revenue expenditure. When we answer this question, the first thing we need to identify is what is capital expenditure, what is revenue expenditure, and how do we treat it. As you have just got a kind of a brief idea from the above question, capital expenditure is the expenditure that's going to provide us long-term benefits, whereas revenue expenditure is the expenditure that's going to provide us short-term benefits. Thereby, capital expenditure is normally recorded in the statement of financial position or the balance sheet under the category of non-current assets. But revenue expenditure is normally recorded in the income statement under the category of expenses. So, if we treat a capital expenditure as a revenue expenditure, that means we have treated a non-current asset as an expense in the income statement. So the non-current asset figure is missing in the SOFP, or the statement of financial position, whereas it has been subtracted as expenses in the income statement. Then they are asking us, if that happens, which will be incorrect? Does this transaction affect the bank balance? Obviously not, because it's only a matter of a non-current asset and the profit. Does this affect the creditors? Not at all. This is not at all, but yes, the net profit, because now we have subtracted a non-current asset as an expense. So we have taken an extra expense, which means we have underestimated our profits, understated our profits. Therefore, the net profit will be incorrect in this case. Considering question number 8, it is from rather a very interesting topic in the syllabus, which is the final accounts of a manufacturer. So the question asks us, where should a manufacturing business show the cost of delivering its goods to customers? Alright, cost of delivering its goods to customers. When it comes to a manufacturer, normally a manufacturer makes use of different final accounts. First of all, they make use of the manufacturing account, which is used to calculate the cost of production. Next, they make use of the trading account in case if they are selling the goods they manufacture. And the income statement in order to make use of the information on other expenses so that they can calculate the net profit. In case if it is a partnership or a limited company, then yes, they might use an appropriation account to segregate their profits among the shareholders or partners. Considering this situation, they're just referring to a manufacturing business, Thereby, we need not assume it to be a partnership or limited company, so we have to just take it in simple hands as a sole trader. In this case, where do we show the cost of delivering the goods to customers? Obvious, this is nothing to do with production, so we are not going to put it in the manufacturing account. This is nothing to do with a partnership or limited company, so we are not going to put it in the appropriation account. Profit and loss account and trading account. Profit and loss account normally includes all other expenses. The cost of delivering its goods to customers is normally considered to be delivery cost, or we also can take it as carriage outwards. So profit and loss account includes this expense. In other words, the carriage outwards is indicated in the profit and loss account. So the answer is option C. Skipping out of question 9 since it's no more in the IGCSE Edexcel O-level syllabus. Let's move on to question number 10, which is the last MCQ in this paper. What is the purpose of liquidity ratios? Alright, so liquidity ratios in general, what does it indicate as far as you know? The term liquidity itself gives us the clue. Liquidity basically means the ability to convert your assets into cash. So the liquidity ratios basically indicates your ability to settle something using cash, or your ability to settle your current liabilities in simple terms. So which is the answer for sure? It is option C. But why can't we take the other options? If we take option A, to analyze how profitable the business has been, not at all, because this is why you use the profitability ratios. To assess the level of trading, no. For this, we make use of something called efficiency ratios, which you'll study when you come to the IAN level. To measure how all the assets contribute to earning profit, no. Again, it's the function of efficiency ratios. So the answer is option C. Concluding all the MCQs from here, I hope this video is useful, and I hope you will continue to enjoy the rest of the videos. And up next is the video on 2018 June IGCSE Edexcel paper, section B, where I would explain to you in detail how you answer section B questions. Please bear in mind, although the paper structure has changed for the upcoming year, and there are minor changes in the syllabus, these questions do provide you a really good practice. So keep watching and do not forget to subscribe and comment if required.